When can PSU bank staff be probed for NPAs? Government lays down new norms for when bank staff may be investigated if a loan gets bad. How does this address staff fears and how can it help the economy? The Finance Ministry has issued a fresh set of norms to guide state owned banks in adopting a uniform staff accountability framework for non performing assets up to rupees 50 crore. The aim is to protect employees from their bona fide actions and at the same time make them accountable for any wrongdoing or any inaction on their part. The guideline will be implemented with effect from April 1, 2022 for accounts that turn NPAs beginning the next financial year. What is the new framework? The Staff Accountability Framework for NPAs accounts up to rupees 50 crore issued on October 29 by the Department of Financial Services advises public sector banks to revise their staff accountability policies and framework procedures with approval of their respective boards. Banks will have to complete an accountability exercise within 6 months from the date an account is classified as NPA. Depending on the bank's business size, the guidelines suggest threshold limits for scrutiny of the accountability by the Chief Vigilance Officer. If NPA is caused by external factors such as change in government policy, natural calamities, non release of government subsidy, grant, it should not attract a staff accountability examination, the guideline say. Why was the need felt? The step has been taken to protect bankers and remove their fears of being investigated for bona fide business decisions going wrong. Bankers have provided feedback to the government that sometimes decisions on credit sanctions are slow, as bankers fear investigative agencies may come after them if the accounts turn NPA. This approach not only adversely affects staff morale but also puts a huge strain on the banking resources. While punitive action needs to be taken against the officers having malified intent involvement, it is essential to ensure that bona fide mistakes are dealt with compassion, says Indian Banks Association. What led to such fears? After the 13,000 crore loan fraud on Punjab National Bank by diamond trader Nirav Modi came to light in 2018, senior officials of the bank were hauled up and those involved had to face tough action. This and a series of other unrelated frauds led to an environment in which PSU banks have become extremely cautious and risk averse. Even in the case of bona fide corporate loans, this was seen as stalling credit deployment, which is crucial to support economic growth. In December 2019, Finance Minister Nirmala Sitaram assured the heads of state run banks of protection from undue harassment from probes into their lending decisions. She said after a review meeting with top bankers from state run banks that fears of three C's CBI Central Bureau of Investigation, CVC Central Vigilance Commission, and CAG Controller and Auditor General was holding back banking decisions. What are the rules laid down? Up to rupees 10 lakh. Staff accountability need not be examined in NPA accounts with outstanding up to rupees 10 lakh. The government has argued that most loans up to rupees 10 lakh are template based and do not constitute a major percentage of the NPA portfolio by amount. Such accounts can turn into NPA even due to a slight change in circumstances, including a family health crisis or a shutdown, leading to disruption in cash flows. Rupees 10 lakh to rupees 1 crore. For examining staff accountability, banks may decide on a threshold of rupees 10 lakh to 20 lakh, depending on their business size. For loans between 10 lakh and 1 crore, which mainly include home and car loans, SME and agriculture credit, staff accountability is to be examined by a committee formed at regional controlling offices. For preliminary examination, the controller will submit to the committee a brief report covering details of the loan and observations in inspection audit reports for the previous year 4 years. If the committee finds a case of staff accountability exists, This will be examined by a fact-finding officer. Rupees 1 crore to 50 crore. Accounts in this range are mostly credit facility sanctioned to business units, warranting examination by a specialized unit within the banks. NPA accounts in this range should undergo a preliminary examination by a committee constituted at one level higher than the sanction level. An account sanctioned at the regional office will be taken up at the zonal level, those at the zonal level by circle office or head office, and so on. The committee should be headed by an official senior to the sanctioning authority. For preliminary examination by the committee, a detailed report should be submitted through the controller. If the committee finds material lapses in any of the processes, the account may be referred at the discretion of the committee to the controlling audit officer for detailed examination of staff accountability. What is the existing framework? Currently, different banks are following different procedures for staff accountability exercises. Banks carry out such exercises in respect of all accounts that turn NPA. This has made many bankers reluctant about taking exposure in new units or projects. As a result, credit offtake to small units that require bank funding were starved of liquidity, especially after the pandemic began. What about the accounts above rupees 50 crore? According to Finance Ministry notification, for NPA accounts in this range, staff accountability is to be examined as per the existing guideline. However, the RBI has set a framework under which banks must initiate and complete a staff accountability exercise within 6 months from the date of classification as a fraud. Details of the exercise and the action taken may be placed before the SCBF, Special Committee of the Board for Monitoring and Follow-up of Frauds, and intimated to the RBI at quarterly intervals. The RBI says banks should bifurcate all fraud cases into vigilance and non-vigilance categories. Only vigilance cases should be referred to investigative authorities. Non-vigilance cases may be investigated and dealt with at the bank level within a period of 6 months. In cases involving very senior executives, the board or the audit committee may initiate the process of fixing accountability, which should not be held up on accountability of the case being filed with law enforcement agencies. How will the new norms improve credit growth? Banking industry executives say the new norms will help bankers take credit decisions faster and help support the economy. Slow credit deliveries to industries due to fear of implication needs urgent address, the IBA said. Non-food credit take-off increased by 6.8% to 108.94 lakh crore during the 12-month period ended September 2021, after 5.1% in the previous year, with the country lifting COVID-induced restrictions and the economy on the comeback trail. Credit growth to industry picked up to 2.5% in September 2021 from 0.4% in September 2020. The growing economy depends heavily on bank credit. The government and the RBI also have on various occasions expressed their concern on slow credit takeoff and have stressed on eradication of fear in taking business decisions. Fair, predictable, and transparent systems and procedures of conducting staff accountability are necessary to eliminate subjectivity, the finance minister said. Thank you.